Hi everyone and welcome to today's More Report on Friday the 5th of February with me, Rich Perry, Market Analyst at Antec Markets. It is Non-farm Payrolls Friday and markets are fairly cautious at the open. Again, tends to be always what we see in the early European session on Payrolls Friday. And today seems to be no different really. You've got equity indices which is sort of mildly mixed really. You've got sort of FTSE slightly higher, CAC slightly higher, DAX slightly lower. And forex markets are just giving back some of the gains that they've had actually against the dollar in the last couple of days. Really, the dollar's sort of just starting to claw back some of those losses. The main one, main driver, the main the main underperformer. Get my words out. Is sterling coming on the back of that dovish quarterly inflation report that we had from the Bank of England yesterday. And sorry, that's the wrong chart. And let me just show you the dollar. That's the trade-weighted dollar. Huge sell-off actually in the last couple of days. Just unwinding some of that move today. But the outlook for markets is certainly not positive, is it? Look at treasuries. Treasury yields are sort of moving to sort of 12-month lows. It's not good. That's not good at all. That's not good in an environment where the Fed's looking to tighten. And it certainly doesn't bode well, particularly for growth going forward. Also, the fact that the yen is strengthening as well. It's just, again, another negative. Gold is up. This is generally market negative for the setup going into this payrolls report. But what are we looking out for from the payrolls report? Well, we have got an expectation of 190,000 on the headline number. Which hasn't actually changed, interestingly. That was it's been 190,000 according to Reuters all week, and that even despite a stronger than expected ADP number. So markets not really expecting too much to come out of this payrolls report today. Expecting 5% on the unemployment, no change again, and 0.3 on the hourly earnings. Now, last month was a disappointing average hourly earnings. And again, it's not expected to see the year-on-year data pick up at all, really. So that average hourly earnings is at 0.3 is fairly sort of in line with recent trends of earnings growth not being able to pick up. So again, it's not really a particularly hawkish report that's expected here. And to be honest, even though the headline numbers have been strong recently, the expectations of a rate hike for the States continue to fall away. Yesterday it was around about sort of 14% probability of a March rate hike, so it's pretty much written off by the markets now. In fact, we're actually down at I think 40% for December, so the markets aren't even sort of seriously questioning whether we're going to get any rate hikes this year now. So very interesting that we're seeing that. But today, going into this payrolls report, we're pretty much fairly settled, and be interested to see what happens today. Don't forget, there is a lot of spikes that go on payrolls Friday, so be mindful of that when you're trading. Now, my chart of the day is the DAX. The DAX is my chart of the day because it's still playing around with these key fib levels, isn't it? I mean, I spoke about the DAX last week where it was just again hitting that overhead 61.8% fib level. I was wondering whether it was going to fall away. It did ultimately fall away, and it's now finding support at the 76.4% level again. 76.4 is at 93.08. 92.70 was yesterday's actual low. But certainly you would argue that is a massive support, isn't it? August low, September low, January low. Is it now also going to be broken? If that is broken, it sort of pretty much opens us up for a full retracement back to the 8355 level, which was that October 2014 low. So a really significant support there on the DAX today. And it doesn't look as though the DAX is all that performing well anymore. It seems to be as though it's underperforming the FTSE. I think sort of the rebound in oil has certainly helped FTSE, but certainly the DAX is looking like the underperformer at the moment. What we have... Oh, sorry, that's the wrong chart, isn't it? That's gold. The DAX near-term chart, certainly negative configuration, isn't it? Lower highs, lower lows, finding resistance around that falling 21-hour moving average. You've got the the RSI, which continues to fall over around the sort of 40s, 50s area. It's continuing to sort of go along with the theme of rallies being sold into. Again, we saw another one yesterday, that late afternoon rally sold into the close and then continues lower today. So it certainly isn't in any sort of positive technical setup whatsoever. You'd be selling strength. There's a big resistance, big sort of pivot level around 9600 on this, but I think any rallies are a chance to sell. Any rallies back towards that falling 21-hour moving average, which is currently 94.50, I think would be a decent area, because I think it's going to put more pressure or increasing pressure on this 93.08 key Fibonacci level, and if it breaks that, as I said, it doesn't look healthy. Daily momentum indicators again also looking like they've got further downside potential. RSI at 35 tends to go back towards 30, doesn't it, in the big sell-offs. Stochastics falling sharply. MACD line's also just turning lower, so it doesn't look healthy at all, this DAX chart. So yeah, we'll see how this one pans out, but it doesn't look good. Anyway, obviously good luck in your trading today, and I'll speak to you later. Thank you.